Welcome to Module 9, where we'll look at everything that occurs post-purchase. Whilst the process to purchase a commercial property is critical, let's not forget that you're not just finished once you have the property. So what actually happens once you've successfully purchased their investment? Once the property is yours, it's important to manage it well and make any upgrades, additions, or changes you could to add value to the property. In this module, we'll look at aspects of property management, including whether you should self-manage or hire an expert. As commercial property involves business, you will also look at how to select and manage a tenant. Unfortunately, not every property purchase is perfect. So what happens if something goes wrong? We'll explore the strategies and approaches that will help you survive downturns. Even if you are focusing on a more passive set and forget strategy, it is still important to understand all aspects of the property post-purchase so you can get the most out of your investment. So let's jump straight into it and enjoy the next lesson. Welcome to your lesson on all things property management. Managing a tenanted commercial property sometimes appears easy since the tenant is often responsible for all the outgoings. Therefore, it might seem the only job is making sure the rent is paid on time. But there's actually quite a lot more to it than that. Engaging a professional property manager to look after your commercial investment will save you a lot of money in the long run. If you do decide to manage the property yourself, you need to keep track of a few things. The tenants, including their rent payments, outgoing payments, rental increases, lease renewals, and any breaches of lease. Record keeping, including rent receipts, outgoing receipts, rates notices, regulation notices such as fire checks, council permits, and updates to the Retail Leasing Act. Repairs and maintenance, organising repairs, liaising with the tenant, engaging local contractors, understanding maintenance costs and quotes, and becoming familiar with the building itself. Rent, know the current market and the Retail Leasing Act if applicable, manage rent reviews and lease options, keep track of rental arrears, and do bank reconciliations. Tenancy disputes, for which you'll need dispute resolution skills, a high level of communication skills, and a negotiation ability. Finding new tenants, marketing and advertising for new tenants, and reviewing new tenants. Understanding legislation changes, for example, COVID-19, and knowing what incentives are required. Having a strong, detailed lease that stipulates what's required of the tenant and ensures the tenant understands the lease is really important and will assist in covering all the issues above. However, there are a lot of moving parts in commercial property, and I do recommend always using a property manager. Let's look at some more main points between self-management and using a property manager. There's quite a lot of management involved with a commercial property, so you need to assess how much time you have, whether you can give enough attention to the detail needed, and have the right personality to resolve disputes. It's also critical to have the correct software and methods to manage the property. The main reason most people self-manage is to save money and increase their cash flow, or because they don't want to trust someone else with their investment. However, poor property management can cost a lot of time, money, and stress. If you're time poor and your effort is better directed elsewhere, a property manager may be the better answer. A good property manager will normally cover their costs by getting a cheaper rate on tradesmen, staying up to date on rental increases, and ensuring that these are actioned when applicable. Sometimes the tenant will even pay your property management costs, so then it's a no-brainer. On the other hand, if you have the time and the necessary personality traits, you may manage the property better than a property manager would, because for you, it's a personal investment. If you are managing the property yourself, you must be available 24/7, as issues, minor or otherwise, can arise at any time. If you need a new tenant, you'll also need to make the time to assess tenant applications and conduct tenant interviews. This can be tough if you're a borderless investor and live in another state. It's wise not to become too friendly with the tenant because the relationship can be difficult if things go wrong with the tenancy. Having a property manager can be an advantage here as it creates a level of separation between you and the tenant. So if you decide to proceed with a property manager, how do you pick the right one? The right property manager can be the difference between a property that is tenanted long-term and a vacant one. Your relationship with the property manager is basically a partnership. You want to be looking for a long-term relationship that has good rapport and communication so that the manager understands your objectives and works in relation to how you want the property to operate. Whilst it is your property and you want to maximize the profits, you should also take their advice as they are the experts. When searching for a property manager, look for someone who sees his or her job as relationship building, not just completing transactions. Their focus should be on increasing the value of your asset while maintaining and increasing cash flow each year. Finding a manager who has experience in your property's type, size, and location will give you a much better outcome. Local knowledge is extremely important, and obviously you need them to be close by to handle tenant issues. You want your manager to have a good reputation and be well connected in the community with many contacts. This can be particularly beneficial if you want to purchase something else in that area, as they'll often have the inside scoop or hear whispers regarding other businesses and properties that may be coming up for sale. The manager also needs to be up to date with modern, digital-based electronic resources to be able to digitize all hard copy documents such as bills, invoices, and checks received. This is becoming more important with borderless investors and the increase in technology. Some commercial property managers I use now even use AI technology to automatically sort incoming emails into council rates, water rates, receipts, and things like that. So it's definitely worthwhile having a chat with one who's up to date with the industry. You'll often find that the selling agent for the property will push to have their company manage it after the sale. However, just because they sold the property, it doesn't necessarily mean they're the best person to manage it. These teams are often sometimes divided in a completely separate selling and property management. Make sure to shop around and research to get the best manager. One of the best ways is by referral from another commercial property investor. There are now lots of commercial investor groups on social media, so asking for referrals has become relatively easy. You can also ask your buyer's agent if you're using one. If possible, it's always best to visit a potential property manager at their office, so you can get a feel for their staff and their organisation skills. If everything's untidy and there are mountains of files on every surface, it can be a sign that they're overwhelmed and unable to dedicate sufficient time to your property. I understand this can be difficult if you are interstate, but it will give you a good indication of the property management business. Let's now look at some of the questions you should ask any potential property manager. You can ask things like, how long has the company been in business? How long has your dedicated property manager been at the business and what's their previous management experience? How many residential and commercial properties does the business manage? How many residential and commercial properties does your dedicated property manager manage? Does your dedicated property manager have a personal assistant? Is there a separate team from residential to commercial property? How often are routine inspections carried out? Could you provide me some examples of other properties you manage in the area? What's the typical time to relet a property similar to mine, and can you provide some examples? How do you run your marketing campaigns? What's the procedure for tenant reviews? What's the procedure for collecting arrears? When was the last time you evicted a tenant and how did that go? You want to make sure that they have a thorough management process and to see how they compare with the other companies. A good property manager will have a solution to a problem before they inform you of it. And when there's a vacancy, a good property manager will be proactive in advertising it and include you in all the steps of the process. Importantly, they should communicate well with you. If your potential property manager is slow to respond to your calls or emails, you may want to consider someone else. So now that you have decided on a property manager, when is the best time to hire them? It is best to engage a property manager as soon as you have gone under contract, as the sooner you get them involved, the better. Even with all the due diligence you perform, you won't have the same knowledge as a seasoned property manager, and they will often be able to give you some inside information on the property and location. They also add another layer to help with a smooth settlement transition and ensure you have all the correct documents. They can also perform the pre-settlement inspection for you and will often do this at no charge if you're engaging their services. Once you've appointed a property manager, they will then send you all the paperwork needed to authorize them to carry out management activities. Many property managers will let you sign the documents electronically. Documents and information they require will include the lease agreements, copies of the current and outstanding invoices, the dates on which each tenant pays rent, how much any bonds are and where they're held, whether the outgoings are paid on demand or allocated monthly and the current amounts, and the settlement statement if you've just purchased. One major difference to residential properties is the bond, which for commercial properties can be held by the owner's choosing, even in their own personal bank account. Many investors opt to hold the bond in their own account as it enables control and the funds can be invested. Once the manager has reviewed all the documents, they will contact each of your tenants to set up a relationship and discuss future proceedings. Ideally, at this point, your work is largely finished and you'll have a set and forget property. Property manager costs. So, what will it cost to have a property manager? A typical commercial property will see the manager working a couple hours a month on average for invoicing and general management. Most property management charges are based on a percentage of the gross rent, calculated on a tiered approach. Managing a lower renting property requires the same amount of work as a high renting property, so managers will charge a higher percentage to earn the same amount of money. The fees can vary between 3 and 7% of the gross rent, and are very much negotiable. However, in general, if you have a tenant paying $300,000 a year, the fee is going to be closer to 3%. Whereas if you have a tenant only paying $30,000 a year, the fee will most likely be closer to 7%. Most property managers will expect to be paid $1,500 to $5,000 a year as a minimum. Remember, the fees are tax deductible to the owner, so overall there's not much financial gain to taking on the management responsibilities yourself. Also, in some cases, the lease agreement states that the tenant is responsible for paying for the management fee as an outgoing. Just like a commercial lease, the fees on commercial property management can be negotiated. For example, you could handle a rent review yourself and perhaps save yourself up to 10% on the re-let fee. It's best to negotiate any such reductions before you engage the manager and to record the details on the agency agreement. Be aware of hidden fees, however. Some managers will charge you for each extra service. In the download section, we've included this table which shows a typical property management fee structure and possible fees during their ownership. Thanks for watching, guys. See you next lesson. Welcome to your next lesson, where we look at selecting and managing a tenant. Remember, one of your biggest assets in commercial is your tenant. So it's essential to think of them as a business partner and get the correct tenant for your property. Just like choosing a property or property manager, when selecting a tenant, it's essential to perform due diligence before signing a lease. Let's review the checklist of things to look at when vetting tenants. Get references from previous landlords if possible. How long have they been in business? What was their previous location and why did they move? If they're a startup, ask about their business plan. Request a rental ledger of at least 3 months of bank statements. Do they appear to be capable operators with long-term business prospects? Check the owner's identity. Run a credit check on the owners and the business. What is the owner's general presentation like? Request evidence of their assets. And do they have experience in the business they propose to be operating as your tenant? We all know that starting and operating a new business is a risky proposition and failure rates are high. You need to determine whether the prospective tenant will be good for you long term or whether you'd be better off keeping the property vacant until you find a better tenant. The answer will depend partly on supply and demand in your location, but selecting the right tenant is crucial. The relationship you have with the tenant is very important. Some properties, especially big retail ones, will have an on-site manager you need to have a relationship with in addition. The relationship you have with your tenant is very important. Some properties, especially big retail ones, will also have an on-site manager you need to have a relationship with. A common issue with tenants is their lack of understanding of the lease requirements with their responsibilities. They often will just look at the lease and the price they need to pay instead of all the details. Making sure you or the property manager explain these clearly at the start before the lease is signed means you'll have fewer future problems. If you have any questions about the tenant or the lease, don't hesitate to contact your solicitor to ensure you're happy with everything. Be careful if you're buying a property with an expensive fit out, such as refrigeration or a commercial kitchen, as even if you're not responsible for these during the lease, if you have ultimate ownership of them, when the tenant leaves, you could be up for maintenance while the property is vacant. Remember, if you have a long vacancy period like 12 months and the new tenant moves in and the refrigeration system isn't working, you could be up for $10,000 to $20,000 just to fix it. If you have a property with these special assets, make sure they are being maintained regularly, especially if you don't have a tenant. Additional outgoings such as rates and electricity need to be paid and charged onto the tenant if these are their responsibility. Your property manager will usually need to get involved, for example, if the electricity, heating or water needs to be fixed. You want the property to be well maintained, but in the most cost-effective way so the tenant's expenses are minimised. Having a cost-saving, savvy property manager will assist with this. This will encourage your tenant to stay on and help ensure their business remains profitable. Of course, during any tenancy, keeping electronic records of everything is important, including dates, times, and requests. Also make sure all your correspondence remains very professional, especially if you're self-managing, as if things go wrong, you might end up in a tribunal or court situation. Let's move on now to when you have multiple tenants. Tenant mix. For multi-tenancy properties, such as a retail strip, the tenant mix and the tenant compatibility can be important in the success or failure of a business. As commercial leases are comparatively long, it is essential to get the right mix from the start, as it can be difficult to correct straight away. The tenancy mix is especially important in the retail space, such as suburban shopping centres. The foot traffic should complement the other tenants and not have too many competing businesses, such as 4 cafes in a row. You want the best mix possible, such as having a medical centre, hairdresser, cafe, and specialist goods stores. Commercial tenants will often place a high value on a property's image and reputation and want to be near businesses that increase exposure to their business. One tenant's business can contribute to the success of others. When filling a vacancy in such property, it's best to analyse what kinds of businesses will fit well with the others. You can communicate this to the existing tenants to ensure no clashes of competing businesses. For example, a nail salon and a hair salon. These are complementary services but are not competing. Whilst complementary services can work well together, a wide variety of tenants can also bring more foot traffic to the property. Sometimes though, you can have competing tenants that work quite well together. You may have a whole complex dedicated to one sector. For example, baby, where you may have a range of stores that sell all baby goods like toys, prams and cots, etc. We've also seen the furniture superstores, which is more in the industrial space, where you have all the furniture stores in one complex, because people want to roll through and look at as many options as they can in the one place. Same thing with car dealerships. So you can have the same businesses, you just have to assess what's the purpose of that commercial space in that location. Rental increases. Back in Module 3, we looked at rental increases specifically in regard to leases. Let's return to the topic as it relates to dealing with tenants. Obviously, as a landlord or owner, you'll want to maximise property's rental return and yield. However, this doesn't always mean getting the highest market rent or imposing rental increases. This is often a rookie mistake I see first-time investors make. They come in and they always want the highest rent and the biggest rental increases. However, having the highest rent doesn't mean you'll have a good long-term tenant. There's a balance to be struck between keeping tight vacancies and obtaining top market rent. New or inexperienced commercial investors are more likely to be guilty of raising rents too soon or too quickly. Generally, steady increases are best unless there is a huge demand for the property and you're being paid rent that is under market value. Steady rental increases are better for the tenant and their cash flow management. The key is to build a good relationship, and being fair is often the best way to keep a long-term tenant. Tenants will weigh up what they're paying against what they're receiving, so providing them with good value is essential. The benefits of this over the long term will outweigh the short-term gains from high rents. Whilst you may want a higher rent, it actually costs a lot more to secure a new tenant than it does to retain an existing one. Along with the leasing and advertising costs, you also incur the risk of taking on a new business. With the period of vacancy plus the costs, your highest priority instead should be trying to retain the tenant to give you the best long-term return. Rent should be increased with care, as this can put a lot of personal, emotional, and business strain on the tenant, and they could feel the need to investigate other options. They'll respond better to rental increases when they can see they're receiving more value, perhaps because you're providing better facilities. Note that sometimes fixed rental increases can put rents above market rent. If this happens, it can be worth lowering the rent to keep the tenant. If you're looking to give a rental reduction, try to offer a 3 months rent as opposed to a rent reduction. As we know, the lease's strength and the property's net yield are tied to what the property's value is. Giving 3 months free rent is actually a better outcome than signing a new lease with a 5% lower rental amount. So, when faced with the choice between finding a new tenant or reviewing the rent for your existing tenant, it's better to offer 1 or more months of free rent to keep your tenant, rather than a rent reduction. Well, that's all for selecting and managing a tenant. See you next lesson. Welcome to your next lesson, where we'll discuss how to survive a negative downturn. Even with a well-selected property, unfortunately, you may experience a downturn in your investments for many reasons, mostly out of your control. It could be the economy, the demand for your type of commercial premise, an act of God, or because your tenant's business is struggling. In these circumstances, the ability and value of your property manager, if you're using one, will shine. You can help mitigate the risks of downturns in general by buying a versatile commercial property that is flexible and could have multiple uses. For instance, a retail space that could be turned into an office space. This could reduce the length of vacancy if the tenant leaves. Let's have a look at some ways to survive specific downturns. A decline in the industry or the tenant's business. The first downturn may be a decline in the industry or your tenant's business is struggling. This is why undertaking due diligence on the tenant and the business is so important. If the business is struggling, you have a few options, such as you may assist them with the costs of renovations or offering 1 or more months free rent. The tenant's business is your business, so knowing when to give them a concession and show compassion is important. However, a rental reduction or free rent won't necessarily solve the tenant's problem. Unfortunately, the downward momentum when a business struggles is usually hard to stop. So you need to know when your tenant's financial situation is irrecoverable and when to cut the assistance. Try not to get emotionally involved, as we know the media often portrays landlords as wealthy individuals with spare cash. Your tenant may think the same and try to take advantage of your generosity. A lot of tenants will sometimes blame their business difficulties on the quality of the property. If this happens, the best advice is to stay calm and stick to the lease terms. Either party can be held accountable if the terms are not adhered to, including not paying the rent or the outgoings required. If a tenant breaches the lease, you or your property manager need to act quickly to get on top of any issues to mitigate future losses. Again, this is where an experienced property manager is crucial and you'll be able to navigate this situation. When the problem is first noticed, contact the tenant immediately to see if it can be rectified. If the tenant is late on rent, find out when they can pay it. You can accept a partial payment and give a deadline for the rest. You then need to check that it is paid on the agreed date. If payment hasn't been made, it's time to contact your solicitor and tell the tenant they're in breach of the lease. A breach of lease notice is then served on the tenant, outlining the issue to be addressed and by what time it needs to be done. If the breach isn't remedied, you may need to take further action, such as locking the tenant out of the property. This is when having a strong team will help ensure timely action and you abide by the correct process per state regulations. If it appears the tenant won't be able to rectify the breach, start advertising for a new tenant as soon as possible. You can also take legal action against the tenant to recover any losses incurred, such as lost rent until the property is relet, outgoings the tenant should have paid, and advertising costs to find a new tenant. Usually, the maximum loss you can recoup is the rent that would have been payable till the end of the lease option. In the worst case, you should have a bond or bank guarantee to fall back on during this time. During the process, both parties should seek legal action to help lessen the damages and risk. To reiterate, it is best to work with the tenant through these issues. Sometimes their business is seasonal, which may produce unexpected costs that put them in a negative position. If the tenant can recover, keeping them is much better than eviction, where you may have vacancy periods and potential legal action. The next downturn would be acts of God, also called force majeure events. These are big events or natural disasters such as earthquakes and tsunamis. These are circumstances outside anyone's control that could not be foreseen or guarded against. In Australia, these natural disasters would be events such as floods, cyclones, bushfires, and droughts. Recently, after the COVID-19 pandemic, legislation has been changed to say that a pandemic is considered an act of God, so insurance policies must be checked closely. It's essential to check whether building and landlord insurance will cover these possibilities depending on the risk for the property's region. For example, it may be excluded if your property is located close to or in a flood zone. This should have been assessed in the due diligence period before the property was purchased. You can also consider having a surveyor risk assess your property and provide actions to improve its resilience to such an event. For example, if you are located close to bushland, you could have bushfire mitigation works carried out on the land surrounding the property. If your insurance doesn't cover these events, working with your tenant is important to ensure the best outcome for both parties. For example, if your property was affected by a flood and the business took 2 months to reopen, you would provide free rent when the business could not operate. Once the business is reopened and trading again, you will organise a plan for that rent to be paid back. Global economic crisis. Another potential downturn relates to the economy. It impacts property prices and business success, so any global economic crisis will affect your commercial property. Depending on your tenant's industry, it may increase or decrease their business. One of Australia's largest recent recessions occurred in 1990 to 1991. During this time, unemployment rose by about 5% and the Australian share market dropped about 40%. We did see tenants struggle during this period, which led to large rental concessions and longer vacancies. However, the worst fall of any capital city was maximum 2.3% in capital value. 3 of the capital cities experienced growth during this time to a maximum of 6.8%. This demonstrates the stability of property in the Australian economy. Even in recessionary times, there are commercial property investments that can weather the storm and even thrive. For example, healthcare services are always in demand regardless of the economic conditions, so medical assets can be a stable investment, generally with long-term tenants. Industrial and logistics properties are often used for essential services such as manufacturing, storage, and distribution, which are less impacted by a recession. It is particularly important to consider investing in commercial properties with a history of stable income, as such investments are less likely to be negatively impacted by economic downturns. Pandemics. Another downturn that became prominent in 2020 and the years that followed was the COVID-19 pandemic. Whilst the worst of the pandemic has passed, the effects on the global economy and real estate market continue. We saw several businesses struggle and many were forced to shut down temporarily or for good. This pandemic has changed the demand for certain property classes with a decreased need for office spaces and an increased working from home culture. We also saw, and are still continuing to see, an increase in industrial types and a shift from the classic retail properties as more and more retailers go online. During any pandemic, it is important to work with your tenants and discuss any claims they may make for rent reduction due to decreased profits or having to close. Consider the following steps. Refer to government incentives. Some tenancies will not be affected by a pandemic, but may still ask the owner for a discount on their rent. In this case, suggest that the tenant explore the government grants available for small businesses under the stimulus measures announced. This is the first thing to do. Consider rent deferrals. Some tenants may ask for the rent to be waived for the period they cannot trade normally. However, it may be better to discount the rent to zero for a period, say a few months, and then ask them to sign a longer lease as part of the deal. This will strengthen your lease, improve your long-term income security, and increase the value of your property once the pandemic has passed. More importantly, your tenant will remain in the business. Consider rent relief. Rent relief or a discount may be the best option in the end, as you want your tenant to still be in business long-term. One strategy is to discount the rent by, say, 50% and then ask your bank to defer the interest on your loan so that you don't fall behind on repayments. Refer to government legislation. If the government has enacted legislation, such as a mandatory code of conduct covering how landlords and tenants are to deal with each other in the pandemic, all parties must comply with this legislation. This is designed to protect both the landlord and the tenant and the economy. In summary, your investment may experience a downturn, which is completely out of your control. So, what can you do to mitigate the risk as an investor? The best way to survive downturns and curveballs is buying a versatile premise. If you're buying an industrial property, for example, Buy something that can be used for fabrication or storage or service-based businesses. Or a retail property that can double as an office. If you buy in a main little suburban area, then the cafe you own, for instance, could quickly be converted into a law office, accounting firm, or anything like that, depending on the area's demand. Versatility is key here, and buy in an area you think will be strong over the next 10 to 20 years. That's it for me, guys. See you next lesson. Welcome to your next lesson, where we'll look at strategies to add value to your property. Commercial property comes with the terrific advantage of adding value and increasing your overall returns. There are so many ways to value add. If you're checking out a property with a selling agent and you notice some ways to increase its value, definitely keep that information to yourself. Changing the property's use. A property can be repurposed in part or overall. This could involve converting an unused or common area space into lettable space or upgrading a storage area to office or industrial space. Increase net lettable area. If you can expand the property's net lettable area or NLA, then you receive more rent as the square footage has increased. Methods of increasing NLA include reconfiguring the floor plan or building a mezzanine floor. Create multiple tenancies. Breaking up the commercial property into smaller tenancies increases the price per square metre for rent and reduces vacancy risk. For example, a 1,000 square metre warehouse might rent for $100 per square metre, but 4 250 square metre warehouses might rent for $120 per square metre. Your value could be increased by 20% due to the higher rent per square metre. Raising or lowering rents. A simple way to add value would be to buy an under-rented property and then bump up the rent at the end of the lease term. For example, let's say a 500 square metre warehouse rents for $100,000 per annum, meaning the property is $200 per square metre. If the market rent is $240 per square metre, then the property is under-rented by 20%. If you have a plan and the means to get the rent back up to market level, your rental income will be 20% higher, which can increase the value of the commercial property by 20% as well. If you understand how to find properties that have rental upside, you can create equity quickly by increasing the income. Remember though, raising rents needs to be done on a case-by-case basis, as keeping a tenant and maintaining a low vacancy level is the goal. Improving the property's quality and image. Renovations such as refurbishing, painting, and landscaping can make a dramatic difference. This will normally allow higher rents and increase the property's yield and value, and generally keep your tenant there for longer. Sometimes these improvements will even be initiated by the tenant at no cost to the owner. Getting a stronger or longer lease. Having an appealing tenant or long lease can increase the property's value. The longer the lease, the greater the security. Creating new sources of revenue. Some examples include installing ATM machines, solar panels or charging stations, vending machines, renting out parking or storage space, taking on off-peak rentals, allowing advertising space, installing mobile phone towers and repeaters, and offering a serviced office. Adding or upgrading the property marketing. Additional marketing can boost rents and lower vacancies. This can be as simple as having better street signage, a website, or targeted advertising. This aims to increase demand for your location and in turn raise the rental rate. Removing underperforming tenants. This is particularly applicable in retail centres, where one underperforming tenant can reduce foot traffic, create competition for another tenant, or give rise to a poor culture in the centre. Improving property management. Good property management is essential. We discussed this in depth in a previous lesson, but keeping a good property manager will help secure a long-term tenant and reduce vacancy. Development. As with residential properties, it is possible to develop commercial properties. This could involve subdivision, expansion with new buildings, or adding an extra story to increase the value or cash flow. The best thing about commercial is there are so many ways to add value, and you can do more than one of the options we just talked about and try to get the most cash flow you can out of the property. Now time for an example. Adding telecommunications base stations. Let's have a look at a simple example of a creative addition to a commercial property. Here we have a corner fish and chip shop with a takeaway restaurant and residential apartment on top of the restaurant. The value add was adding telecommunication devices on top of the roof. Whilst a small rental concession would normally be provided to both the tenants because the eyesore on the roof, adding these devices could hugely increase your cash flow. So here we have a commercial property that's getting 3 different income streams. Of course, council permission must be sought for value add items such as this. Here's another example, solar power installations. Another example involves the installation of solar panels on an industrial building to reduce electricity costs. The system has been sized to eliminate the electricity bill. In this client's example, the electricity bill was in the owner's name with the usage being on charge to the tenant at an agreed rate stipulated in the lease. In terms of the numbers, before the installation, the bill was $3,000 per year. And after the installation, there was actually a credit or refund of nearly $500, meaning there was a total saving of $3,500 per year. Another great point is there is potential to use this as a bargaining chip when negotiating a new lease or lease extension. For example, if you choose to extend or re-sign, you'll provide them with a 5% discount in year 1, but bump it up to 10% discount for years 2 and 3. Another example, adding a mezzanine area. Adding a mezzanine to an industrial building structure can increase the property value by increasing the available net lettable floor area. The tenants will benefit from the increased floor space and more flexible storage options, and the landlord will gain more square meterage, which can significantly increase rental profits. In this example, we have the initial warehouse size of 124 square meters. The net rent was $37,200 a year, which equals $300 per square meter. At a 6% cap rate, the property was valued at $620,000. The new mezzanine was 56 square meters and the cost was $80,000 to build. This means the new net lettable area of the property is 180 square meters. Our net rent is the initial $37,200 plus the new rent of $11,200, which was charged at 200 square meters for the mezzanine. You will find that mezzanine floors are generally charged at a lower square meter rate and they have more limited uses. For example, you can't store vehicles on them or they have certain weight limits. So our total net rent is $48,400. And if we again use the cap rate of 6, our property value is now worth $806,666. In summary, by spending $80,000, we have gained $11,200 a year in net rent and the property's value has increased by $186,666. Of course, you do need to get council approval for this and ensure that a registered builder handles construction and everything is compliant. Sometimes adding a mezzanine means you need to have additional car spaces, so it's best to talk to a town planner before starting anything. If you have the right property, this is an excellent strategy to increase the income, which directly increases the value. These are just a few examples that my clients have used in their commercial properties. You must look at your own properties and determine which value strategies will actually work. If you're an active investor and looking to expand your portfolio quickly, then it's important not to set and forget. You need to always look for ways to improve your property's value. Call and ask a local town planner to see if there's been any change to the zoning, to the floor space ratio rules, or anything else that may affect the property. As mentioned previously, it's best to use an independent town planner as they're generally more experienced and are motivated to help you in the hope of receiving some future work from you. Quite often, a tenant may wish to improve the shop front's presentation or add an extra mezzanine area, but they don't have the money to do it. If you pay for the work and then charge extra rent to recoup the costs, you not only have a happy tenant, but a higher rent will also increase the value of the property. Thanks again for watching, guys, and see you next lesson. Welcome to your lesson that specifically looks at insurance for commercial property. As we mentioned, insurance needs to be organised during the acquisition phase before you settle on your property. In most states in Australia, the risk of the property passes to the buyer one day after the contract date, so you need to get it organised straight away. As we know, natural disasters are extremely common in Australia, so it's crucial to have comprehensive insurance in place. In early 2022, we had massive storms and flooding that affected the east coast of Australia. This has been the most expensive natural disaster in Australian history so far, leading to nearly $6 billion in insurance claims. These acts of God are unforeseen and can happen anytime, so being covered is essential. So what exactly is commercial property insurance? Similar to residential, it is just insurance that protects against specific risks related to commercial property. It is generally a bit more complicated than that for residential property. The tenant or business owner may choose to include coverage for loss of income, business interruption, and extra expenses such as moving. Let's have a look now at the different types of coverage available. First, building coverage. This includes the building structures and any additions or alterations done to your building. Also included in this category are any fixtures or equipment attached to the building, such as lifts, staircases, and ventilation. Next is contents coverage. This covers the contents inside your business premises, like furniture, equipment, and other valuables. As a property owner, you may be letting the premises unfurnished, or your lease might require the tenant to insure or be responsible for any furnishings like this. The next type of insurance is business interruption coverage. This covers loss of rental income due to an insured event occurring at your premises. For example, if a fire or storm at your premises causes damage and you cannot lease your premises for a certain period, then you may receive compensation for lost income while it's being repaired. This cover does not protect against tenant default when the tenant stops paying rent. If the event is not specifically covered, for example, it floods, but you don't have specific flood coverage, then no replacement income will be paid out. The last coverage is landlord liability. This provides coverage for members of the public suing you for personal injury or property damage that you are responsible for as the owner of the property. For example, a piece of old carpet comes loose and the tenant or visitor slips, falls, and injures themselves. While this may sound simple, this could be very costly if you have to defend against legal fees and future payouts. As an investor, you've worked hard to purchase your investment. You want to make sure it's properly protected in the event of an accident or disaster, as well as protected from lawsuits or legal action. Similarly, if your tenant has worked hard to build their business and brand, you'll want to ensure they are covered. When selecting your commercial insurance coverage, it is best to work with an experienced insurance broker. Similar to a mortgage broker, an insurance broker is essentially free of charge to you and the insurance company pays them. They can help you choose the right policy for your property and business and will help you understand exactly what is covered by your policy and what is not. Don't be afraid to ask questions. They are there to help and give you the coverage you need. So, how do you choose the right insurer? Just as we have said throughout this course, just because it's the cheapest option doesn't mean it's the best. The most important thing is to ensure that you are covered, not what the price of the policy is. Remember, you need a strong team around you who are experts in the field. So use an insurance broker. A great insurance broker will work with you to find a policy that is competitive in price and fits your needs. No matter how well you maintain your commercial property, accidents and disasters can still happen. Any kind of damage can be a big setback to both the landlord and tenant, regardless if the business is big or small. A severe storm could damage your roof, a pipe could burst and flood your office, or a customer could slip and fall in your store. If any of these happen, you'll need to file a commercial property insurance claim. Insurance claim can sometimes be complicated, so here are some tips to minimize the stress and help ensure you get financial compensation. Number 1, document the damage. Take photos and videos of the damage as soon as possible. These will be evidence for what needs to be repaired or replaced. Next, notify your insurance broker. If you used a broker, they'll be your advocate throughout the claims process. They'll help you navigate the paperwork and communicate with the insurance company on your behalf. And finally, make repairs. Once you have the approval from your insurance company, start repairing the property immediately. The sooner you get the tenant and their business back up and running, the better. Taking these steps after a commercial property claim can help reduce the disruption to your property so the tenant can return to business. Lastly, of course, insurance advice is a unique decision, and how you choose to protect your commercial property will depend on your circumstances, your needs, and your risk tolerance. The most important point though is to make sure you're covered. Thanks for watching, guys. See you next lesson.